10-year yield retreats from the psychologically important 4.5% level, and from an analytical standpoint, this rejection is not just technical but behavioral, signaling that markets are pushing back against tighter financial conditions, and your critique of Federal Reserve influence, particularly referencing strategic ambiguity, aligns with a growing sentiment among analysts that central bank communication is intentionally flexible to maintain optionality. But where I would refine your argument is in recognizing that this ambiguity itself becomes a market driver. Because uncertainty forces repositioning, and repositioning drives volatility, which in turn fuels moves like the one we are seeing in silver. And when we compare your assertion that the Fed manipulates markets with a more neutral analytical stance, I would frame it as the Fed shaping expectations rather than directly controlling outcomes, because ultimately markets react not just to policy, but to the interpretation of policy. And this is evident in how quickly metals responded to Powell's comments. And in my view, the decline in yields combined with a softer dollar creates a dual tailwind that is structurally supportive for metals. But again, sustainability depends on whether these conditions persist, because if yields rebound or the dollar strengthens, the same forces could reverse. And therefore, while your conclusion that these factors are driving the rally is correct, my addition would be that these are fluid variables, not fixed supports, and the market's reliance on them introduces an inherent instability that must be monitored closely by any serious investor or analyst expanding further into the macroeconomic landscape. The labor market data adds another layer of complexity. And your inclusion of the JOLTS report is particularly important because it provides insight into underlying economic momentum, and the drop in job openings to 6.88 million, along with declining hiring rates, suggests a cooling labor market, which in turn strengthens the case for potential rate cuts. And this is where your narrative about supportive conditions for metals aligns well with broader economic theory, because weaker labor data reduces inflationary pressure expectations and increases the likelihood of accommodative monetary policy, both of which are positive for gold and silver. However, from a high-level analytical perspective, it is essential to question the depth and reliability of this data. Because as you Arabic Aleph Arabic Shin Arabic Alif Arabicrat, Arabica to the possibility of a cooked books, there is always debate Arabic heat Arabic wow, Arabic clam the accuracy of labor statistics. And while skepticism is healthy, an institutional analyst would focus less on questioning the data itself and more on how markets interpret it, because ultimately prices move based on perception rather than absolute truth. And in this case, the perception of a weakening labor market is enough to drive bullish sentiment in metals. And when comparing your cautious stance about overextending capital with a professional risk management approach, I would strongly agree that liquidity management is critical. Because even in a bullish environment, timing and capital allocation determine long-term success, and your hesitation to buy at lower levels due to limited dry powder reflects a disciplined mindset, which is often overlooked in retail discussions. And from my perspective, this discipline is what separates sustainable investing from reactive trading. And therefore, while the current rally may create a sense of urgency, a structured approach remains essential. Looking ahead at monetary policy expectations, the probabilities derived from tools like FedWatch provide a forward-looking lens into market sentiment, and your breakdown of rate expectations across upcoming meetings highlights a gradual shift toward potential easing. Particularly as the probability of rate cuts begins to rise in June and July. And from an analytical standpoint, this gradual increase is more significant than any single data point, because it reflects a changing consensus, and markets are forward-looking by nature. Meaning that even a modest increase in rate cut expectations can have a disproportionate impact on asset prices, especially in sectors like precious metals that are highly sensitive to interest rate dynamics. And your observation that a move into the 20% probability range could trigger further upside is insightful. But I would expand on that by emphasizing that it is not just the probability itself, but the rate of change in that probability that matters. because rapid shifts in expectations tend to create stronger market reactions. And when comparing your view that continued upside could validate the bull run with a more cautious analytical stance, I would argue that confirmation requires not just rising prices but alignment across multiple indicators, including sustained yield declines, continued dollar weakness, and consistent macro data supporting easing. And without this alignment, the risk of a short-term bubble increases, particularly given the speed of the current move. And therefore, while I agree that the conditions for a bull run are forming, I remain cautious about labeling it as fully established at this stage. Finally, when we bring all these elements together, including your personal trade decision of buying mercury dimes below spot, it adds a practical dimension to the analysis. Arabic of Arabic Farsi ye Arabic wav, Arabic noon, Arabic kaf, Arabic letter 601 market narratives ultimately translate into individual actions. And your ability to secure physical silver at a discount highlights inefficiencies that can exist even in rapidly moving markets. And from an analyst's perspective, this is where theory meets execution, because identifying macro trends is only part of the equation, while capitalizing on pricing discrepancies is what generates real value. And comparing your enthusiasm for building physical holdings with a broader strategic view, I would say that physical accumulation during volatile periods can be a prudent long-term approach, provided it is not driven purely by short-term excitement. And in conclusion, the current surge in silver represents a powerful intersection of technical breakout, macroeconomic shifts, and market sentiment. And while your interpretation captures the excitement and key drivers behind the move, my analytical perspective frames it as a transitional phase with significant upside potential but equally notable risks, requiring careful monitoring of yields, dollar strength, labor data, and policy expectations, because in markets, especially in commodities like silver, the line between a sustained bull run and a short-lived bubble is often defined not by the magnitude of the move, but by the durability of the forces supporting it.